Tracy. Welcome to the Money System, where we explain how money really works.
Worried about your savings shrinking and your job security vanishing? What if I told you the real reason might be happening halfway across the world in a place you least expect? It's not about your local politics or the latest tech bust. It's about China's massive, ticking debt bomb, and it could have a bigger impact on your wallet than you think. Let's cut through the noise. You've probably heard whispers about China's economy, maybe something about ghost cities or struggling companies. But it's often dismissed as their problem. Here's why that's a dangerous mistake. For decades, China fueled its incredible growth by borrowing money. A lot of money. We're talking about a debt pile that's now over 3 times the size of its entire economy. Imagine your personal debt being 3 times your annual salary. Scary, right? So, how did they get here? It started with a simple idea: build, build, build. Local governments were encouraged to borrow heavily to construct everything from skyscrapers and high-speed rail to massive apartment complexes. This created jobs and made the economy look fantastic on paper. The property sector became a giant engine of growth, accounting for nearly a third of the economy. Everyone, from big corporations to everyday families, poured their life savings into real estate, believing prices would only go up. It was a gold rush. But here's the catch. A lot of this building was based on speculation, not real demand. This led to the famous ghost cities' entire metropolitan areas with brand new buildings, but very few people. The debt used to build them still needed to be repaid, but with no one moving in and no businesses opening, where would the money come from? The first major crack appeared with Evergrande, a name you might have seen in the headlines. This real estate giant, once the second largest in China, defaulted on its massive debt of over $300 billion. Think of it like a huge domino. When Evergrande fell, it didn't just fall alone. It sent shockwaves through the entire system. Suddenly, confidence evaporated. People stopped buying homes, fearing their investments would be worthless. Other property developers, like Country Garden, started to crumble under similar debt pressures. The gold rush was over, and the hangover was just beginning. Now, you might be thinking, okay, that sounds bad for China, but what does it have to do with me? Great question. We live in a deeply interconnected global economy. China isn't just a distant country. It's the world's factory and a huge consumer of goods. First, let's talk about your investments. Many global pension funds, mutual funds, and even individual investors have money tied up in Chinese companies or in international companies that rely heavily on China. When Chinese companies struggle, their stock values fall. This can directly hit your 401k or your personal stock portfolio. The ripple effects can spread to global markets, causing widespread uncertainty and volatility. Remember the 2008 financial crisis. It started in the US housing market, but quickly went global. A major debt crisis crisis in the world's second-largest economy could have a similar, if not larger, impact. Second, consider the global supply chain. From the smartphone in your pocket to the car you drive, many products rely on parts made in China. This means shortages of products we rely on every day. And what happens when supply goes down but demand stays the same? Prices go up. That's inflation hitting you right at the checkout counter. If China's construction and manufacturing industries grind to a halt, their demand for these materials plummets. This can trigger economic downturns in those countries, creating a domino effect that further destabilizes the global economy. It's a chain reaction, and no one is completely immune. The Chinese government is, of course, aware of the problem. They're trying to manage the situation, but it's like trying to defuse a bomb while it's still ticking. They are pumping money into the system and trying to restructure debt, but they're caught in a tough spot. If they bail out every failing company, it encourages more reckless borrowing, what economists call moral hazard. But if they let them all fail, it could trigger a full-blown financial collapse. So, what does this all mean for your future? It means we need to be prepared for a period of global economic uncertainty. It could mean slower growth, higher inflation, and more volatility in financial markets. Your job security could be affected if the company you work for relies on exports to China or components from China. The cost of living could continue to rise as supply chains are disrupted. This isn't about fear-mongering, it's about being informed. The tremors from its debt crisis are already being felt, and they could grow into a full-blown earthquake that reshapes our global economic landscape for years to come. Being aware is your best defense. Thank you so much for watching. If you found this video helpful and want to stay informed on the economic trends that actually affect your life, make sure to hit that like button and subscribe to our channel. Don't forget to ring the bell so you never miss an update. Stay smart, stay safe.
So, we're not smart. If this helped you understand the system, subscribe, like, and share this video.